Nvidia is reporting 85% revenue growth, yet the market has squeezed its forward multiple to a 5-year low. This gap has attracted Michael Burry, who recently established a massive put position, betting that this growth story breaks by January 2027. Tech giants are committing $700 billion to AI infrastructure, but for the first time, investors are hesitating to pay a premium for the hardware making it possible. This chart shows the widening divide. Cloud spending moves towards $700 billion, while Nvidia's multiple drops to 22. To meet demand, Nvidia locked into $119 billion in supply commitments, a massive bet that orders won't vanish. Most of that liability is tied to physical manufacturing capacity at TSMC, turning high-level projections into legally binding debt. This leaves you with a choice. Is this the most discounted entry point in years, or a structural trap built on the hope that big tech never stops spending? Ultimately, Nvidia's value is no longer just about its engineering. It depends on whether its 4 largest customers can actually afford to keep the lights on. The path to a $1 trillion order book depends on the physical transition from Blackwell to the Vera Rubin platform, now integrated with Grok 3 LPX accelerators. Jensen Huang is pivoting the company's hardware to solve a specific engineering bottleneck that threatens the entire industry. That bottleneck is the memory wall. Standard GPUs lose efficiency because they have to constantly pull data from off-chip memory while they process information. Blackwell relies on high-bandwidth memory, but Vera Rubin uses SRAM. Keeping data on-chip removes retrieval delays, delivering 35 times higher throughput per megawatt. Despite requiring mandatory liquid cooling, hyperscalers upgrade to extract 10 times more revenue from existing grids. To lock in this hardware advantage, Nvidia is launching NeMo Claw, a new operating system for the enterprise. NeMo Claw creates a secure environment where autonomous AI agents can plan and execute multi-step tasks without leaving a company's private network. This software stack carries massive recurring fees, ensuring that even if hardware sales slow down, the licensing revenue keeps compounding. By combining this specialized hardware with proprietary software, Nvidia is attempting to keep its 75% gross margins safe from cheaper competitors. But those margins are vulnerable to the one thing Nvidia cannot control: who is actually buying the chips. 64% of Nvidia's receivables come from 3 hyperscalers, while China is blacked out. If these companies delay data centers to protect credit, Nvidia's $119 billion manufacturing commitments turn into a mountain of unsold inventory. This pressure is mounting just as U.S. export controls have wiped out $35 billion in annual Chinese demand. Huawei is now moving into that vacuum, scaling its own production to replace Nvidia hardware across the region. The real danger isn't just the lost hardware sales. It's that Chinese developers are being forced to stop using Nvidia's CUDA software entirely. They are building a parallel ecosystem based on Huawei's frameworks, funded by the state, to replace U.S. chips entirely. While a U.S. spending pause is a short-term risk, the rise of a rival software ecosystem in China is the first genuine threat to Nvidia's global moat. Deciding whether to buy or sell at today's $215 level comes down to how you model 3 specific paths for the next year. This decision tree maps the targets. To understand these numbers, we have to look at the expected $8 in earnings per share and the multiples the market is willing to pay for them. The base case of $262 assumes the Vera Rubin ramp goes smoothly, holding the current 33 multiple against those $8 earnings. To hit the bull case of $305, NeMo Claw software licensing has to push earnings past the $8 mark, while investors bid the multiple up to $38. The bear case of $219 is effectively where we are today. It assumes inventory piles up and the market derates the stock to a high 20s multiple. If you are a value investor, your main concern is ensuring the current price isn't a peak before a collapse. For you, the data suggests a hold. You should wait for next quarter's CapEx guidance to confirm that the hyperscalers still have the cash to fund Nvidia's supply pipeline. If you are a growth investor, you are focused on the structural lead Nvidia holds over its competitors. For you, the current price is a buy. You are accepting the concentration risk in exchange for a hyper-growth monopoly, trading at its lowest multiple in years. The speed of this infrastructure cycle means the window to act on these specific valuations is narrowing as the hardware actually starts to ship. You have to decide if big tech can sustain this pace, or if the market is ignoring the debt building up in Michael Burry's $119 billion trap. Tell me which side of the math you're on in the comments.